In the corner offices of the world's most powerful technology companies, a competition is unfolding that will determine who controls global finance for the next decade. Artificial intelligence companies are not just building tools anymore, they are building infrastructure so fundamental that every financial institution on Earth will depend upon them. This is not a battle between competing products or services. This is about who controls the operating system of future finance. Understanding this shift is essential because the AI companies that win this competition will wield more power over money than central banks and traditional financial institutions combined. Financial services businesses are busily adopting agentic AI, with frontier firms, organizations that embed AI agents across every workflow to drive speed, agility, and scalable innovation, demonstrating the greatest business impact from AI by blending human judgment with AI agents. With a November 2025 IDC study commissioned by Microsoft showing that frontier firms report returns on their AI investments roughly 3 times higher than slow adopters. This 3 times multiplier effect is not accidental. It represents genuine competitive advantage built into the core operations of organizations that move fastest. AI adoption in financial services continues to surge, with spending projected to grow at an accelerated pace, reaching an estimated $97 billion by 2027, with over 85% of financial firms actively applying AI in areas such as fraud detection, IT operations, digital marketing, and advanced risk modeling in 2025. But the real story is not the tools themselves, it is who controls the infrastructure through which these tools operate. OpenAI, Anthropic, and xAI, the 3 AI companies competing most fiercely for control of financial infrastructure, have achieved valuations that exceed those of most public companies. OpenAI reached a $500 billion valuation in October 2025 and is seeking to raise an additional $100 billion at a valuation of $750 to $830 billion by early 2026, representing a 300% increase from its $157 billion valuation in October 2024, and positioning it to become the most valuable private company in history by a significant margin. Anthropic achieved a valuation of $350 billion in November 2025 following its $15 billion Series G led by IconIQ Capital with participation from Microsoft and NVIDIA, nearly doubling from the $183 billion recorded in September 2025, representing the fastest large-scale valuation appreciation in venture history. xAI, Elon Musk's AI venture, closed a $15 billion round in December 25 at a $230 billion pre-money valuation, up from $80 billion at the time of its ex-Twitter acquisition integration. The revenue growth of these companies is staggering in both speed and scale. Anthropic's January 2024 annualized revenue of $87 million grew to $1 billion by January 2025, representing an 11-fold year-over-year increase, then accelerated to $2 billion by April, $5 billion by August, and $7 billion by October 2025, an 80-fold increase in 22 months. Anthropic's customer base has expanded from fewer than 1,000 businesses to over 300,000 in just 2 years, reflecting strong demand for its AI solutions across sectors such as finance, life sciences, and government, with recent performance highlights including a projected $9 billion in annualized revenue by the end of 2025, with ambitious targets of $26 billion by 2026. The financial services takeover. What is particularly striking is how rapidly these AI companies are capturing financial services as a core market. By 2025, about 87% of global financial institutions had implemented AI-powered fraud detection systems, up from 72% in early 2024, showing widespread adoption in core fraud monitoring roles, with over 70% of Tier 1 banks planning to increase AI budgets for fraud detection and AL modernization by 2026. The conversational agent segment led the AI agents in financial services market with the largest share of 42.7% in 2025, as financial institutions focused on real-time customer engagement and automated support, with more than 48% of companies incorporating some form of intelligent automation into regulated operations by the end of 2024. OpenAI released a new flagship artificial intelligence model and a suite of financial services tools meant to be better at tackling office work, ramping up competition with Anthropic as both companies race to dominate this critical market segment, with the model GPT 5.4 more capable of taking on tasks like generating spreadsheets, documents, and presentations while requiring less back and fourth with a user. The infrastructure dependence reality, the most profound shift is that financial institutions are becoming fundamentally dependent on AI companies for their core operations. AWS is expected to earn $1.28 billion in 2025 from Anthropic's usage, with projections climbing to $3 billion in 2026 and $5.6 billion in 2027, with this relationship creating dependencies where financial institutions' cloud infrastructure depends on the partnership between Anthropic and AWS. This creates an extraordinary concentration of power. When Anthropic grows faster than traditional tech companies have ever grown, and AWS captures enormous revenue from that growth, and financial institutions depend on both for core operations, you have created a dependency structure where AI companies effectively control financial system infrastructure. The enterprise AI spending explosion, enterprise AI spending reached $37 billion in 2025, according to Menlo Ventures, representing a threefold year-over-year increase, with roughly equal splits between user-facing AI products at $19 billion and AI infrastructure at $18 billion. This spending pattern reveals where real power is concentrating. The companies that build user-facing products grab headlines. The companies that build infrastructure grab profits and control. The autonomous decision-making agent segment is expected to grow at the fastest rate in the coming years, owing to their ability to process complex financial data and execute strategic decisions with minimal human oversight, with these agents reshaping functions like risk management, credit underwriting, and portfolio optimization, and their adoption is accelerated by strategic deployments from tech leaders such as Microsoft, Google Cloud, and AWS. The profitability question that could change everything, one critical distinction separates Anthropic from OpenAI, the path to profitability. Anthropic is expected to break even by 2028, helped by rising enterprise use of Claude, while OpenAI facing much higher compute costs. Projects about $74 billion in losses in 2028 and is not expected to turn a profit until 2030. This difference has profound implications. Companies that can achieve profitability faster build sustainable competitive advantages. Companies that burn cash indefinitely remain dependent on investor capital. Anthropic projects $70 billion in revenue by 2028, with the surge driven by strong enterprise adoption of Anthropic's AI business products, while the company maintains better unit economics than competitors, suggesting that as enterprise adoption accelerates, profitability becomes achievable faster. When investors pay themselves, a troubling dynamic has emerged in 2025 that echoes patterns from previous technology bubbles. The most complex circular arrangement involves OpenAI's infrastructure commitments, which now exceed $1.4 trillion, $22.4 billion to CoreWeave for GPU capacity, $38 billion to AWS, $250 billion plus to Microsoft Azure, and multi-billion-dollar partnerships via the Stargate project with Oracle, with these commitments vastly exceeding the company's revenue generation capacity, creating dependencies that require continued capital injection to service. Hyperscalers collectively committed $300 billion plus to capital expenditure in 2025, with Alphabet, Meta, Microsoft, and Amazon together expecting $380 billion in combined capex through 2025 and 2026, with the dollars spent by one player often returning as revenue for another, creating the impression of breakneck growth that may not fully reflect organic market demand. The market control question, as AI companies dominate financial services, the question of who actually controls global finance becomes increasingly complicated. AI-driven agents will automate financial decision-making and user interactions, with financial power shifting from institutions to individuals, giving consumers more control. While trust becomes the defining factor, who will users rely on to build and manage these AI-driven financial assistants? With AI seamlessly integrating financial services into user experiences, fintech and AI-first platforms could replace many of the functions traditionally controlled by banks, with financial institutions now facing a major decision: should they develop their own AI-driven solutions to compete with big tech? Or should they collaborate with these platforms to remain relevant? The AI companies that control the future of finance will not necessarily be the ones with the biggest models or the smartest researchers. They will be the ones that most effectively combine raw capability with enterprise trust, regulatory compliance, and financial sustainability. In one realistic scenario, OpenAI could leverage Microsoft's ecosystem to secure enterprise clients by mandating GPT access through Azure and marketing AI-driven analytics tools, potentially replicating Oracle's 1990s dominance, with 89% of Fortune 500 companies already using ChatGPT Enterprise, offering stable revenue opportunities but risking antitrust actions. Anthropic's Claude 4 performs on par with GPT-5 in enterprise evaluations while operating at 40% lower costs, challenging OpenAI's premium pricing strategy, while Elon Musk's xAI is gaining momentum in the scientific field through Grok 3's peer-reviewed research contributions. The fundamental truth is that artificial intelligence companies are not just building tools for finance, they are building the infrastructure through which finance operates. The companies that win this competition will control who can access credit, which investments are recommended, how fraud is detected, and essentially every other decision in the financial system. This concentration of power in AI companies is one of the most significant economic developments of our generation, yet it remains largely unexamined by the public and even by many financial professionals.